E&J Capital. Today we're talking about beta. What is beta? Should you buy high or low beta stocks? So we're going to do this on the laptop. Shout out to Jean-Michel. I'm a big fan. If anybody got the hookup to Jean-Michel paintings, then slide him through because he's a stud. He was a stud. Rest in peace. I'm old school. Let's go to paint. So first off, what is beta? Beta is the measurement of volatility for a stock or portfolio compared to a benchmark. The benchmark we usually use is the S&P. Beta basically means how sensitive or risky a stock is compared to the market. It doesn't have to be S&P, but it's a benchmark that you want to compare it to. We're going to use SPY. SPY is an ETF. So let's say SPY has a beta of 1. The white line is SPY, right? Let's say this represents Apple. We're going to take a break. I'm going to clean this up, make it look presentable, go walk the dog. I'll be right back. Beta is a measure of stock's volatility in relation to the market. So I have some examples. These aren't accurate numbers. This is just an example. So let's say SPY has a beta of 1, Apple has a beta of 2, and Johnson & Johnson has a beta of 0.5. If Apple has a beta of 2, that means on average, Apple tends to move 2 times the distance of what SPY does. If SPY moves up 5% in a day, Apple may go 10% in a day. If SPY goes down 3%, Apple may go down 6%. And if you look over here, the white line is SPY. I try to make it as accurate as possible. But the blue, it moves a little, farther than SPY would. It's a little bit more volatile. You always want to make sure that, you know the volatility. And if you look at Johnson & Johnson, it's 0.5, so it would move half of what SPY would move. If SPY goes up 10%, Johnson & Johnson may only go up 5. But on the other hand, if SPY is having a rough week, SPY went down 20%, it was a real bad week, Johnson & Johnson may only went down 10%. And it's good to know the beta of your portfolio beta, because if you're long term, you check your portfolio and it's all high beta stocks, that may hurt you in a rough market. It's been a bullish market right now, so high beta is good because you get to capitalize on the market going up. If you have high beta stocks, then those tend to move even farther than the market would. They tend to outperform the market. Beta could be positive. It could be in line. If a company is like a beta of 1.3, it's pretty much in line with how SPY moves. It could be positive, where it's much higher than how the SPY moves, much more volatile. It can be in line, or it could be negative. Let's add a negative in there. Let's do SH. SH is the ticker of the short SPY ETF. If we wanted to add it to here, how do you think it would look? It's the opposite direction. This is SPY, the white line, so the short SPY would be the opposite. I don't recommend short SPY, but that would be a good hedge position. If you have mostly high beta stocks in your portfolio, you want a little bit downside protection. Instead of buying puts or shorting something, you can buy, the inverse of SPY, which is the short SPY ETF, SH. If you look on Thinkorswim, you could do it on here. Go to Studies, Add Study, Compare With, and let's do a custom. Let's do SH. The purple is SH. So when SPY goes up, SH goes down. It's kind of like when people trade UGAs and DGAs. If you have a large portfolio and you want to make sure that you're not leaning towards one side, it's called diversification, when you buy different stocks from different sectors because they move a certain way. So if the market goes down, you're not all the way affected because another stock may move the opposite way SPY does. That would be -1, or they move much more than SPY does, so you may be affected more. And you don't want to have just a portfolio full of stocks that mirror the S&P, because you can buy index funds that mirror it for cheaper. The low-cost index funds that mirror the market, but if you want to be more diversified, you want to buy higher beta stocks to capitalize off bull markets. And if you want to hedge with maybe lower defensive type stocks with low beta that doesn't move as much if a market goes down. But we have a couple problems with beta. Since we use historical data to find a stock's beta, it doesn't automatically mean it will be the same beta forever. Since companies change in strength, profitability, scandals arise, trends change, it will change how volatile that stock is compared to the market. You may also get a different beta if you use different time frames. You know, a 3-year time frame beta may differ from a 10-year, may differ from a 1-year. You know, so, but this is a measurement tool that has been used for a while, and if this is helpful for you, then you learn something new. In general, you know, you want high beta stocks for bullish markets, low beta stocks for bearish markets. You want to be diversified. You don't want all the same stock. You know, if they all move the same way, it's just cheaper to buy an index fund. Next video, we'll talk about alpha. Alpha is another tool that pretty much aligns well with beta, E&J Capital. If you learned something, like. If you enjoy the content, subscribe. If you got a question, throw that in the comments. We're out.